G'day, welcome back to AusBiz, Australia's only live streaming business and markets channel. Great to have your company on this Thursday afternoon. And look, the election's all over. It's decided because Sportsbet have just announced that they're paying out on Biden. So forget CNN, forget Fox News, anything. Sportsbet's paying out on Biden. So it must be a foregone conclusion. Markets solid today on our market. Good night in America, and I think they're happy because yes, Biden gets elected, but he doesn't control both houses, a bit like the status quo, what has been under Trump, just a new president going through. So there are the checks and balances going forward, and markets like a bit of certainty. For the next 60 minutes or so, we're going to take a look at 10 stocks that you've suggested we take a look at, and we put it to two experts. Joining us from Adelaide, our studio in lot 10 there, Tim Haslam from Catapult Wealth. Tim, good to see you, sir. How's your week been?
G'day, guys. Oh, excellent. Thanks for having me back on.
Yeah, no, good to have you aboard. Didn't get out to the State of Origin. Was Adelaide a bit of a buzz last night with State of Origin, or being a AFL heartland, didn't care much?
Oh, personally, if Port Power's playing, I couldn't care less, mate.
All right, I forgot. You're a Crow supporter, are you? No. Maybe we won't have you back on in the future. No, only joking. Only joking. Henry Jennings from Markets Today joins us in our Barangaroo studios. Henry, good to see you.
Good to see you.
How's the week been for you?
It's been good. It's been interesting. It's been exciting, that's for sure. It's never dull in financial markets, is it?
No, exactly right. You've got US elections. One of the things that has been worrying me a bit is all these recent IPOs are all underwater really quickly at the moment, aren't they? We've had a flood of them.
Well, I guess we went through a flurry of ones that just went absolutely nuts, and they were doubling and tripling on listing. Yeah. And then I guess that just kind of gets the wannabes involved, and you get a few duds. And of course, we had news this week that Ant Group, the world's biggest IPO, was actually pulled. So it's been, we've had RBA, we've had the Melbourne Cup. It's just been all happening.
It's amazing. That Ant one in China, if you haven't caught up, it was going to be the biggest financial float in history. Yep. It's basically Alibaba's bank, isn't it? And Jack Ma, of course, who's a great visitor to Australia, has connections here in Australia as well, personal connections. He was called in by the Chinese government, the financial regulators, and went, no, maybe you're getting a bit ahead of yourself. And 3 days out from the float,
I was going to say, they did leave it till the midnight hour. I mean, it was supposed to float today, and it was pulled when? Tuesday? I mean, it's, if you have got problems with the float, hey, you know what? It's coming. No, say something.
It's a bit deeper than that.
He said some stuff a couple of weeks ago that I don't think really helped either.
It's flexing your muscles, I think, there. Interesting. All right, before we get into your 10 stocks, let's take a look at a stock of the day that I think is making news. Of course, National Australia Bank, latest of the big four banks to take a hit to full-year cash profits. Lenders near 30%, 37% slide in cash earnings, coming in just under 3.7 billion net profit after tax from ordinary activities fell by almost half. Bankers cut its final dividend to 30 cents a share for a full year payout 60 cents. Ross McEwan, Chief Executive, says the outlook for business remains highly uncertain. The pace of recovery uneven across industries. So Tim, what do you think of the NAB result, and what's it like as an investment?
Look, I mean, you can replace NAB with any of the banks. Profit down 37% or whatever it is. Costs increasing, provisions and remediation. They're probably doing the right thing by being cautious with that sort of thing. At the end of the day, look, all the banks ex CBA are looking cheap from a price to book value ratio point of view. For us, we think that you got COVID rolling off, Melbourne reopening, the federal budget was very household friendly. All those things are good in terms of the bad loans. And in terms of the one-off, these remediation costs, that stuff will eventually roll off. So when the economy starts booting up and things get better on, we think that we're going to have a one-off kicker re-rate back up. We certainly think they are cheap from a long term, and then probably it's just a pure value dividend play. So it certainly is cheap. The question is when will that come back? But I think in terms of the world, Australia is looking really good. we certainly have all the groundwork for the recovery to come through. So for us, it's a buy. Just like all the banks, it is a long-term wait-and-see approach.
Okay, so you're buying all the banks at the moment, are you? You've got to buy on...
Ex-CBA, yes. Yeah.
Right.
Yeah, not except for CBA, yeah.
Okay. What do you think, Kevin?
We haven't got any real exposure to the banks at the moment. We made a bit of a conscious decision with that. We just thought the headwinds were too great. The numbers weren't bad today. I mean, we knew they were going to be bad, and they made some nice optimistic noises, but it's really hard when you've got record low interest rates after what the RBA did on Tuesday, and we saw, what was it, CBA and Westpac cut interest rates on mortgage loans, etc.
Only on fixed.
Only on fixed, yes.
Not variable, right.
But that is going to affect margins. There's no doubt about that. So, you know, we're yet to see the real effect of coronavirus on the economy. We've got this sort of stimulated economy at the moment. We don't know what happens when the rug gets pulled completely. So I think there's still a lot of question marks about the whole banking sector. But certainly it's heading in the right direction. With Victoria opening up, things are heading in the right direction. But it's popping up on a few of our scans at the moment as potentially may have turned the corner. But we'd like to see a bit more confirmation of that. Figures help.
Yeah.
But at the end of the day, it's hard to get really excited about them as growth stocks. I think there's better plays elsewhere.
Because over 10 years they've been horrible performers, haven't they?
They've been terrible.
The top four.
They've been terrible. You know, the timing is everything in the market. You know, at the end of the day, it is. And you look at a lot of sectors, apart from buy now, pay later or technology stocks. Over a period of time, gold stocks have been awful as well. And you know, BHP were $47, not 10 years ago, and now they're $35. So timing is everything. But the banks, it's hard to get really excited about them. I've got to say that they're kind of shrinking to become building societies. Right. And with a low interest rate environment, it's going to be about keeping costs down, remediation, keeping the bad debts under control. You know, they've got fintechs nipping at their heels. They've got the buy now, pay later guys nipping at their credit card margins, etc., etc., etc. Hard to get really excited, but it is starting to show. A few sort of scans are showing that maybe we should look at them again.
Okay, all right. Let's get stuck into your 10 stocks you'd want us to have a look at. First up, Henry Tina wants a view on Link Administration. It's basically an administration platform for superannuation funds, mortgages, corporate markets. It's been under sort of a bit of takeover activity, hasn't it, from some private equity guys? Yeah. Carlyle Group and Pacific Equity Partners. PEXA is the jewel in the crown for a Link, which is an electronic conveyancing company. It owns 44% of Commonwealth Bank. I didn't realise Commonwealth Bank settles 80% of its mortgages through this PEXA division.
There you go. I didn't know that either.
Yeah. What do you think of Link?
Well, it's, as you say, it's corporate action is happening at the moment. We've got a $5.40 kind of one of the usual non-binding indicative takeover approaches. And then there's the fact that Link want to sort of separate PEXA and do a deal with private equity, I think at $3.80 ex PEXA. Right. So it's kind of complicated. The whole thing is pretty complicated at the moment. They have allowed due diligence, certainly a hold with all this corporate activity around. And as you say, I mean, PEXA is kind of the jewel in the crown to some extent. That's obviously they're valuing that at $1.60, I guess. But it's been going sideways. It'll probably continue to go sideways till we get more clarification. So it's definitely a hold.
Right, which that chart sort of shows when that bid came in. That's the recent little spike up and trending sideways.
And as usual, the company said, shareholders do nothing, wait and see, see how things pan out. But clearly there is corporate interest in this business. It's struggled for a little while. It's got some European, UK stuff which has struggled a little bit. But if it did demerge PEXA or do something with it, it's going to be interesting. So it's definitely a hold, but 486, here we are. 540 is the upside, maybe 360 is the downside. It's kind of It's like a Biden bet.
Yeah, absolutely. Tim, what do you think of Link?
Yeah, I agree. I mean, it's a fair way off the 540, isn't it? It's a good business. One of the major players in super fund administration, they're playing on that thematic of super funds trying to rationalise costs. So we're seeing that big trend of them taking over, outsourcing the administration. So that's a good, strong trend. It's got a very highly concentrated client base. And we used to be worried that the low-hanging fruit's been picked. So the fact that they've gone to LAS and PEXA is a good sign that they're seeing that. We certainly think that PEXA is the diamond as well. For us, it's a hold. Even before the takeover offer, it looked good. So probably these guys are being a little bit opportunistic, but certainly it's valuation-wise, it's looking cheap.
Okay, all right. Tim, Mark wants a view on carsales.com.au, the big digital car advertising platform, biggest in the country, also interest not only in Australia but throughout Asia and Latin America. They have bought similar sorts of platforms. One of the market darlings for a long period of time. What do you think of car sales at the moment?
That's great. That's right. It's one of the great Australian disruptors. I think it's got a 90% market share on the car classified space. 24% of group profit comes from South Korea and Brazil and Latin America. The Australian business is probably looking a little bit mature, so the fact that they've got that overseas growth stuff is a nice little kicker. It's interesting, we're seeing that throughout COVID, they've really benefited. So they saw that people were looking to do online research a lot more before they even stepped foot in a car lot. And obviously with COVID, people are less keen to use public transport. But that being said, the share price has been extremely resilient. I mean, you look at that, it certainly isn't looking cheap at a PE of around 36. For us, we look at Bapcorp and ARB. Their sales are going down or being stagnant. I know it's a different story, but we're just finding it hard to see the rationale behind the current valuation. I think previously during the mining boom, when you had the Cubs, the cashed up bogans, that story really flowed through and made sense. But now we're sort of scratching our head thinking probably it's a little bit too toppy for us. Sell, but it's a great quality company if you can pick it up for cheap.
Okay. All right, so would you go, what were you saying about ARB and Bapcorp? Are they, their sales have actually skyrocketed, haven't they? Are they a better bet if you want to get into that motor vehicle sector?
Yeah, so their sales have been stagnant, and they've had some issues with them. So during COVID, we're interested to see where the money's going. So just sort of watching the share prices together, trying to rationalise those two together.
Okay, Henry, car sales.
It's been weird, hasn't it? How during COVID, people have gravitated to shopping online, and not only shopping for plasma TVs, but also for cars. And
big ticket items.
Big ticket items. Used car prices have actually been going up. Yeah. A lot of the problem is the dealers can't get the stock because of supply chain issues. So there is a bit of a shortage around. If you go to the dealers and there's a 5-month wait for your favourite ute, or you can go to car sales and you can buy a demo or a whatever. Yep. I mean, I like the stock. It's a great dominant platform stock. They've obviously got some overseas exposure with Korea. Latin America could come good as well.
Look at that 5-year chart. It's really performed, hasn't it?
It has performed. I mean, it is dominant. There's no other platform like it. If they can roll out as successfully in these other jurisdictions, then it's going to keep going. And I think COVID has taught us that there's winners and losers, and this is one of the winners. They're putting in new features and new little cool gizmos and things, and refining the platform. And there really is no competition here, and there is a lot of activity in the car space. Yep. And it does hinge a lot on the new car space as well, because dealers are a big driver of their business. But this is a good platform stock. It's just
even at $21.
It's not
21.
cheap. Yeah. You kind of got to close your eyes. Yeah. But and if there's a bit of a wobble in the market or a bit of a wobble in tech stocks, then it's one to be on your watch list so that you can maybe try and pick up some cheapies. Certainly a hold. I wouldn't be going gangbusters into this at these kind of levels. Yep. But weekdays, nibble away, accumulate, and I think in 5 years' time they'll still be the dominant player in Australia. There doesn't seem to be anybody really coming up like we've seen with other sort of online platforms. There's no domain to the real estate. It's car sales or car sales. And they should push into these overseas areas.
So quality company,
great management.
In pullbacks,
Yeah, just sit there and look at your price. You look at the charts, $20. You just sit there, and if you get hit, you get hit. You just got to close your eyes. Otherwise, just nibble away at the moment. But it's definitely a hold. It's a good quality company.
All right. Thank you for that suggestion, Mark. Appreciate it. Now, Henry Wong wants a view on QBE Insurance Group, the big general insurance group. Just appointed an interim chief executive to follow Pat Regan, who left in September. So there's a few management issues, shall we say, at QBE. So management issues in a really tough sector.
It's just too hard, isn't it? I mean, QBE has perennially disappointed the market. It's perennially surprised the market as well to the downside. And just when we thought they'd sort of gone through that period,
perennially surprised on the downside.
On the downside,
that's not a great tag to have.
No, it's not. But they did start to turn it around a little bit under Pat Regan, and then it all kind of fell into a bit of a disaster on the management side of things. So it's low interest rate environment. You're basically a bookie. You take a pile of cash, you store it in your big bag, and you hope you don't have to pay out.
Yeah.
So it's hard work. I wouldn't be selling it here. I wouldn't be buying it here. I think there's probably easier, cleaner, vanilla stories without the. We haven't had a major Hurricane Katrina for a while. We haven't had one of these big events. You're looking at a company that's exposed to global climate change in a low interest rate environment that struggles to get any kind of meaningful income on its investment portfolio because of that. It's just hard work.
See, to explain to people, that's their business model, isn't it? They get premiums from us, hoping they don't have to pay us out. If they have to pay out a lot, well, then that buggers their bottom line. But while they hold your premium, hoping not to pay out, they then invest it, wanting a big return on it. So that adds to their profits at the moment. But in a low interest rate environment, it's hard to get that.
It is
return.
because they can't invest in Afterpay, for instance. They've got to put it in safe treasuries, bonds, gilts, etc.
They're getting nothing on.
Which they're getting nothing on, which makes it really hard. And what happens is you get a big disaster. Big disasters are actually not bad for QBE because they have a lot of reinsurance against it. It's the niggly ones.
Right.
Once you get over a certain level, the reinsurance kicks in. And that sort of takes care of it to some extent. And also it means that they're sneaky little buggers, they can then put the premiums up.
Right.
So, if there's a massive storm or a hurricane or something, once it's all over, they can put the premiums up and start to squeeze things higher, get those margins up, which is obviously good. And you want those big ones, because after a certain period, after a certain size of claim, their reinsurance kicks in. But it's the niggly ones, the kind of...
The odd hailstorm.
The odd hailstorm, the $500 million events rather than 750 plus events. So, for me, it's just...
It's too hard.
It's just, insurance is a hard game.
Yeah.
In a low interest rate environment, it's a hard game.
And as we always say on the call, you've got 3,000 companies.
Yeah, why pick the hard ones?
Why pick a hard one? Tim, what's your view on QBE?
I completely agree. For us, it's a hold. I mean, they've had everything but the kitchen sink thrown at them. They had the bushfires, they have the hailstones on the East Coast every year, and now they've had a hit to their investment portfolio, which accounts for about 40% of their total profits. So it's really hard to see what the upside is from here. I mean, we're likely to be in a low yield environment for a very long time. That's the expectation. And so you've got all this downside risk and reinsurance costs, and then there's not much upside. I mean, what's the big thing that's going to kick it up, that's going to bring it up? We certainly think it looks cheap, but given how volatile the markets are, given how unknown it is at the moment, it's just an extra added little bit of risk where you just ask yourself, why do you need this in your life? So completely agree, for us it's a hold.
Yeah, and Tim, when the Reserve Bank comes out and goes, we are not going to increase interest rates for 3 years, you go, wow, okay, we are in a pretty low yield environment for a long time, which almost says to you, money's got to stay cheap for 3 years. So if you can go and borrow and put it in more productive assets, this is a great time.
Exactly right. And that's the thing, like, do you want to wait 3 years for good news? Probably not. There's lots of other exciting stuff out there. So.
Yeah, exactly. All right. Tim, Matt wants a view on a company called Spectre. Now, when I put this in, all the James Bond stuff.
I was going to say, that was where I was
from me online, and I was trying to go, no, I want the stock. Which, Matt, thank you for suggesting it, because I hadn't come across this company before. Security surveillance industry it's in, uses solar-powered security camera systems, which using 3G and 4G technology, using a cloud-based platform. It's quite an interesting little business by the sound of it. One of the real minnows of the market. Have you come across it, Tim? What do you think of it?
Never heard of it before. And this small cap space is probably my compatriots' forte more than myself. But this is the type of stock where you're at a barbecue and someone comes up, what do you do? And then they tell you about this stock they're invested in. And it's like, oh yeah. It sounds very exciting, shark, detection systems and security, very, very sexy, very techy. But I just looked at the chart and I thought, oh my God, this looks like, a basket case. I mean, the profit's been falling off, it's burning cash, it's slowed down its cash burn a little bit. And then you look at the mandates that management have, they haven't delivered really on any of them. So for me, whenever you play in this space, it has to be the risk-adjusted return. It's not just a good return. There's so many other options out there. For us, this is just too hard. I mean, if you're an existing investor, and the other thing is with these little things, there's a lot of times there's a lot of insider trading stuff going on that there's no way you can really compete with them. I personally, unless I see some green shoots, some positive news, some positive momentum, it's not one I would touch. I mean, it looks like it still has a lot more downside risk in it as well. So for us, it's a avoid.
By a look of the sort of block position on the chart, it's incredibly illiquid as well.
Yes. It's certainly it sounds fun and sexy. It's a punter one. It's certainly not an investment.
Yeah. Henry?
I should have brought the white cat, shouldn't I? I could have sat there like Blofeld from Spectre and been quietly stroking it away.
Yeah.
It's a $5 million company. It's illiquid.
Is that all it is?
It's a $5 million company. Okay. It shouldn't really be. It's here for whatever reason from an accident in the past.
They sold a good story on the float when you look at that 5-year chart. It was at 47 cents.
Yeah, they sold a good. They usually do sell a good story to begin with. It's a $5 million company, and they've just raised $930,000 bucks at an SPP at 5 cents, which is where the share price is. Funnily enough, it's illiquid. They're in businesses which could benefit from the 5G and the Internet of Things. So there's that big addressable market. But this is a punter special. This is, as Tim rightly says, this is a barbecue one where someone says, "Oh, I've just been told about this fantastic stock." Yeah. I think for me, it's too. I mean, I go small.
Yeah.
I'm quite happy to go small.
Yeah, you usually are happy.
But I'd still be quite happy stroking the cat, to be honest, and avoiding this one. I don't know enough about it. I hadn't heard about it till till it was sent through. So I'm going to stick there with the cat.
All right, stick with the cat. Henry, let's go to the other end of the tech extreme, from a little $5 million one to probably a $5 billion company in terms of Telstra. Jared wants a view on the tech stock.
The tech stock in the
mobile market, monopoly business has been in the past. Now a lot more competition.
There is a lot more. I think I'm going back with the cat, to be honest. It's the big Goliath in mobile, but there's other people nipping at their heels. TPG is, they've done the deal with Vodafone, and the share price just done that ever since. I think, to be honest, Telstra needs an invigorated management team. Right. I don't think Andy Penn is the guy. Right. He tries to look cool and techie and talk techie from a Telstra perspective. But at the end of the day, it's a utility service provider whose business model was landlines, which has now been knocked off by the NBN, and et cetera, et cetera, et cetera. It's really hard to get excited about Telstra. I don't think he's the man for the gig. And I think if they got someone in that wore a T-shirt or wore a hoodie or actually had some sort of enthusiasm for the tech side of things, maybe.
Okay. But it's been put to me, they have to spin off all their infrastructure into a separate infrastructure fund. that would be a return of capital out of Telstra and maybe change the dynamics.
They have tried that. They did try that some years ago and they got knocked back. And so what they've been doing is paying back that return of capital gradually as the NBN money has been paid to them in compensation for giving up their copper network. They have been paying that money back to shareholders, which is what's been keeping the dividend afloat to some extent. This is a nice yielding stock, but it's become a utility.
Yeah.
And the big 5G drive that they were pinning their hopes on, it's November. It was supposed to happen this year.
Yeah.
It's November, and we're really not seeing that big 5G drive. Obviously with Apple now with the 5G phone, maybe that's going to help them a little bit. But who really needs 5G? Yeah. And that's the big thing. We haven't had the apps and the stuff built that needs 5G. Okay. It'll come, but it could be 3 years down the track. Right. And that may be too late.
So it's got to act like a tech stock and have that culture rather than a utility stock.
Yeah, it's hard. It's another one of these. It falls into the QBE. Why? There's so many good stocks out there. You look at it, it's just become a utility. It's just become ubiquitous. We just expect the internet. We expect the NBN. We expect all these services, and we're not really that prepared to pay for the big stuff. Right, okay. The big upgrade, because what we've got is pretty good.
Yeah.
So it's hard to get excited about it. But yield wise, maybe, but I wouldn't expect too much growth.
Okay, Tim.
Every person that's watching this video probably has AMP, Telstra, BHP, Rio, and the banks in their portfolios right now. It's one that everyone's very familiar with. One of the biggest telcos, big infrastructure. It's a big, mature, cumbersome beast, essentially, and really they just got to stop the rot. The total group earnings have been slowly declining. We know about the NBN dropping off. They've got the T22 program to try and counter that. They did the nice thing of suspending redundancies during COVID because they didn't want to make people unemployed at that time period, which was very nice. For us, same thing with the 5G network. TPG and Vodafone, they've got experience rolling it out in Europe and Singapore, so they know what they're doing. So there isn't that much of a first mover advantage, in our opinion. So for us, it's probably a 1 to 2 year turnaround story. All they need to do is stabilise earnings, just a flatness to the earnings, and potentially can re-rate. I mean, I think it is a pure yield play, but once that good news comes through, once things settle down, it should probably be okay. I mean, I know people have said that for a long time. But I mean, EBITDA, I think it's 6.5 times versus TPG's 10 times. Relatively speaking, it is looking cheap compared to some of the competitors. So for us, just hold in there. We've got it as a buy. It is looking cheap. It did mount a little rally before. I think probably because of the banks were cutting dividends, people were just chasing yield. Certainly, I think when things stabilise, it can come back, but it's just going to take a bit of time.
Right. So you reckon accumulate it now, or just wait for a while?
I'd say dollar cost average, just slowly pick it up on the down days. It'll be a slow one, and if you're not chasing yield, don't even bother with it. But it is purely just a cheap yield play that should re-rate upwards at some point. Okay,
all right. Let's just run through our first 5 stocks, including our stock of the day. NAB, a no from Henry. Tim thinks the big 4 banks are starting to turn around, so a yes from him on NAB. Link Administration, a hold from both of them because you've got takeover play and activity there. See how that pans out. A hold if you've got it for car sales from Henry. Tim would be selling it, take some profits at this level. QBE just too hard to get into. Spectre too small. And really haven't delivered on their promises in the past. A Telstra, a no from Henry, and Tim saying, look, nibble away if you're a yield investor. That's about the only attraction to it. All right, here at the call, we have our own portfolio. We've been tracking since July the 1st. Any stock that gets 2 thumbs up from our expert panel goes into it. Let's take a look at how it has been doing. The last week down 3.4%. The month is up 4.4%, and since the 1st of July, up just under 14%. If you take a look at some of the stocks we've recently added, Appen, and also following our ETF special that we had on Friday, added Morningstar's Global Tech Fund, the Video Gaming and Esports ETF, the new China New Economy ETF, and the Property Securities ETF as well. Some of the stocks that didn't get a unanimous buy when they came back up on the panel, Novanix and Goodman Group were recently taken out, and you can check out all of the stocks and ETFs in the portfolio. Go to ausbiz.co/portfolio. And this afternoon on the Pulse, we take a look at how the currency markets have reacted to the gridlock in the US elections. Mark Lim from AFEX is joining us at 1:40 this afternoon. All right, let's get into the next round, the final 5 stocks you've suggested us to take a look at on the call this hour. And Tim, Raju wants a view on Nufarm. That's the big crop protection and seed company. They help farmers protect their crops and provide them with seeds for new crops in Australia, New Zealand, Asia, more than 100 companies around the globe. Nufarm, one of the ag stocks. Tim, what's your view on it?
Nufarm, it's certainly been an exciting ride. I must say it's been a stressful one. It's a great one. You think about it, it's chemicals, it's herbicides, that sort of stuff. It's a very cyclical industry, and as such, it also has the seasonal effects on top of that. Europe operations have been hit really hard. They've done the right thing to try and cut costs, and there's been impairments there. For us, we just remember back not that long ago, they were in big trouble. They were in deep trouble. They sold off their South American assets, and luckily it was for a really good price. They were able to halve their gearing ratio from 3 to 1.5. For us, this is just, it does look cheap. From a valuation point, it's cheap. You just need to know what you're getting into. You just need to know it's definitely going to be a bumpy ride. You're definitely going to have variables completely out of their control that's going to be constantly attacking them. Risky. I'm going to put it as a cautious buy, but it probably is. It's got a very strong brand. The lawsuit stuff adds a little bit of flavour to it, but probably cheap. So buy.
Okay, and is it one of those? Because the ag sector goes in cycles all the time, a bit like resources. Is it a good bellwether for the ag cycle? Right, you read that wheat farmers. Literally making hay while the sun shines at the moment, big crop yields coming through. Does that always get reflected in Nufarm's share price? Is it a barometer of that ag cycle?
Yeah, I think so to some extent, but they've got a lot of other stuff going on in the background.
Right.
And especially, previously it was a debt issue, that kind of the noise from Monsanto lawsuits and all that stuff. It kind of sort of made it a little bit extra lumpy in addition to that. But yeah, I think so for the most part.
Henry, what do you think of Nufarm?
It's had a tough 3 years, that's for sure. The chart's been going one way, and that's down.
Yep.
As Tim says, they sold their South American business for a pretty good price, which saved their bacon to some extent. Europe is still a bit of a problem. North America is a bit of a problem. Roundup is what they sell a lot of.
Right.
That's not got the greatest.
The weed killer. Right.
Yeah, that's the weed killer. The Monsanto lawsuits and all the Bayer stuff, that's not good. It swirls around. If you want to go ag, I think there's easier ag stocks to go. A lot of the negativity, though, is priced in, and we've seen that every dog has its day, even AMP. Yeah. I'm not suggesting that this is, but there is a lot of bad news priced into this stock.
Right.
So the merest piece of good news, and we've seen this today with Ingham's to some extent in the ag space. The stock was really under pressure. Feed prices were going up, pressure on margins. The stock's bounced 14% today after its earnings update. So there's clearly, it's not the most research sector. People tend to gravitate towards Elders, which kind of covers all things to all men.
And also Incitec pivot a few people going to on that because of that fertiliser exposure.
Incitec's a pivot with the exposure, and they've got obviously the explosives as well.
Yeah.
But you just kind of think that maybe there's some room for improvement because all the bad is priced in. But again, there's just easier stories out there. It's starting to make some small signals that maybe there's a turn, but they are small signals. And Europe, who knows what's going to happen with COVID as far as the lockdowns go, how that will affect agriculture, how that will affect plantings, how that will affect the economy. I'd just avoid it for the time being until there's more runs on the board from the company proving that they've really turned the company around and the corner has been turned. So just avoid it for the time being.
And speaking of Inghams, for the regular viewers of the call, it was up on Tuesday. Gary Glover from Novus was saying, hey, it's been absolutely smashed. It's a great little business. He would be buying it on Tuesday.
Called it well.
If you did it, what is it, 14%?
Yep.
It's up the last couple of days. All right, Mohammed wants a view on the other major listed classifieds business. We talked about car sales in the car sector in the previous half hour. Mohammed wants a view on REA Group, which does a similar thing in the housing market. If you're looking to rent or buy a house, you usually go through realestate.com.au to check out all the valuations and what's available. What do you think, Henry, on REA Group? They do have a big competitor, or a reasonable competitor here in Domain, don't they?
They do. It's not quite a one-horse race. This is a slight two-horse race.
1.5.
But it is, it's the dominant platform. 62% owned by News Corp, so it's not the most liquid of stocks.
Right.
It is a dominant platform. We haven't seen the property downturn that many predicted.
No. We've
seen a hollowing out in some parts of the market in terms of CBD, people moving out to the regions, but there's lots of activity out there. These guys, it's definitely still a buy, I think. Australians are we're still property nuts, really.
Look at that, March lows, because everyone thought the housing market would be smashed in a recession. $65, now back up to 128.
Yeah, and if we have got rid of COVID in Australia, as long as we don't let anybody in or let anybody out, and we can fire up the internal combustion engine of the Australian economy without inputs from outside, we're going to still do pretty well. And I think real estate is one of those businesses. It's just a quality managed business, great platform. It's thin as well, and it's the go-to. If you want to go tech, you go the real estates, Seek. Well, we've seen a few issues with Seek, but that's the way to go. Those dominant platforms, and I think real estate fits into that.
So even though record high, basically $128.
I think it's just you just close your eyes, and you kind of
and you see it as one of those stocks that would be in your core portfolio. But a foundation stock to your portfolio. Going forward.
And if you get times like back in March when we had the March Madness and the big sell-off and the world's coming to an end, then you just say, well, okay, I believe in the platform, and I believe that our obsession with property is going to come back at some stage, and you just buy it. So you just look for opportunities when the market wobbles, and you pick up quality stocks.
And low interest rates plays into that property market.
Well, low interest rates
and not as high unemployment as the Reserve Bank was saying.
Low interest rates as far as the eye can see. 3 years. So you can lock in those rates. People are moving. People are changing their lifestyles. The work from home thing. This all plays into real estate, I think.
Tim, what do you think of REA?
Yeah, it's another one of the great Australian disruptors, isn't it? It's a great quality company. The move from print to online has been a good long-term trend. Online is cheaper as well. For us, it's more of a story of what matters to realestate.com, and for them, it's churn of listings and premiums and ad penetration. So even though the housing prices have been held up and certainly been supported by interest rates being low, you got to think about, well, on countering that is the responsible lending legislation. And so when people are going to churn and flip and get a lot of those listings through, well, that's what they need. I mean, the house price has been partially held up by a restriction on supply as well. So for us, it's a bit of a false economy in terms of the housing market, but that's what we need. We need to see pure volume going through. So that being said, look, it's held up amazingly well, and that's a testament to its quality. It's a good quality company, but at the current PE and the current valuation, for us, it's a bit too scary to put new money to it. Yeah. So I'd say probably it's a hold. It's one you do want in your portfolio. You might want to take profit on it, but I guess I'll leave it as a hold for now.
Okay, all right. Tim, Leslie, thank you, Mohammed, for that suggestion. Now, Leslie wants a view, Tim, on Viva Energy. They own all of the Shell stations and convenience stores, don't they? And also have that Geelong oil refinery, which has been in the news recently with shake-up of oil refineries. What do you think of Viva? Viva,
it reminds us of Caltex, doesn't it? You know, it's got a petrol stations essentially. It's got a refinery that's got issues and margin problems. For us, it comes down for us to the long-term megatrends. Is this a stock you're comfortable holding for the very long time? And for us, the answer is probably no. I mean, you think about the electric car trend. That's a long way away, but it is coming. We probably think it's 10, 15 years away before it's mass in your face. For us, it is cheap on valuation. It does look cheap, but you'd have to have an exit plan. What are they going to do come that time period when that happens? Either they're going to potentially get taken out, or maybe they might actually look to rebrand themselves and go to electric. Well, guess what's going to happen then? They're going to come knocking on your door with a hand out asking for money for a capital raise, most likely. That's not how it works. It's supposed to be the other way around. You should be giving me money. So for us, it's an avoid. Cheap, yes. I'd say hold if you've already got it. So probably just leave it as a hold.
Okay. Henry?
It's a complicated business, a lot of moving parts. The refinery makes it even more complicated, I guess, and makes it political. And we've seen how that can distract management, especially you look at AGL, which had the whole politics around their coal-fired power stations, which really hasn't done them any favours. And as Tim says, this is a long-term thematic of combustion engines. It is a long-term thematic because we're pretty slow in this country with this side of things. And Viva could very well pivot to electric charging. And at the end of the day, it's a retailer as well. That they sell stuff apart from
with
just
the
petrol.
Convenience stores.
And they've got the aviation fuel side of things. And you're not going to have an electric 747 or electric A380 for some time to come. So it's probably trading in a range at the moment. 160, 180 is probably the range. It's up towards the top of that range. Can't get excited about it. I think the politics around the refinery will get complicated. Victoria opening up again does help. That does drive that demand. But it's just another one of these stocks. You look at it and you think, there's just better things and easier stories to latch onto that that in 5-10 years' time will be bigger than they are. Right. Whereas 5-10 years' time with Viva, you've got to question whether they're actually going to be around in the format they have, or they're going to be converted into blocks of units on every petrol station because they've just got charging stations where everyone's got a Tesla.
Okay, all right. Thank you for that, Leslie. Now, Henry, is the next stock worth latching on to? Robin is asking. Collins Food. It has basically either owns or is franchisee of the Sizzler, KFC and Taco Bell food chains in not only Australia but also Germany, the Netherlands, Thailand and Japan. So if you like takeaway food and you want to invest in it, this gives you a pretty good spread. What do you think of Collins?
If you like Kentucky Fried Chicken, this is the one for you. And it's another one that's been kind of COVID-proof to some extent, and people still wanted to go out and they could pull up in their cars, stay safe, stay contactless, do the drugs, do the drive-through, still feel as if they're getting out and about, getting their quick fast food fix. I do like this stock. I've liked it for a long time, but its price, it's done pretty well. You look at that chart, and it's not come off much, but I think we could easily push back towards $11 again without too much trouble with this one, especially as the economy opens up and people want to go back to doing what they used to do in the old-fashioned way as opposed to the new-fangled way. So still like this one, I must admit. Good management, good product.
At around under $11 here, slightly under.
It's $10 at the moment. I think you could easily see 10% upside. One of the issues, I guess, is it's somewhat weather-related. If you get a great summer, everyone is going to be out and about watching cricket, doing normal stuff, eating KFC, etc. But it has proven to be COVID-proof and pivoted well, and it's great brands, good management. It's hard to fault, apart from the prices.
Yeah.
You'd rather pay $9 than $10, but I think it'd probably go to $11.
Okay. Tim, what do you think of Collins Foods?
Yeah, I think it's an excellent business. It's an excellent corporate model. They've kept control of their branding, really good advertising. The advertising gets me. I sometimes I'll buy KFC. I always regret it because I personally think it's gross, but they always get me again without advertising. So there was a bit of talk about healthy eating trends coming through. I'll tell you what, when I walk around the office at work, I'm not seeing any evidence of that at all. Clearly the Europeans agree it's doing terrible in Europe. Sizzler's obviously probably dead now, but they're still getting a bit of royalties from it. But from us, it's about they've got great cost control, great cash flow, great model, and they've done a great job with the brand. So for us, it's a hold. You would definitely buy it on weakness. I agree, it's looking a bit toppy, but it's a hold. It's a quality company. Okay. And COVID has just proven another thing where, when times are down and times are tough, people want comfort food, and that's just been a great little kicker for them.
All right, Collins Food v Domino's. What's your preferred?
I think Domino's has got an excellent management team. They're doing great things, but Collins Foods has proven themselves. That's the thing. You look at the share price, look at the valuation. They've actually done what they're going to do. Where I feel Domino's is probably a little bit behind them in terms of their development. Okay. So I'd say Collins.
Okay, Henry. Collins v Domino's?
Pizza or fried chicken?
Yeah.
like the taco advert says, why can't we have both?
Yeah.
I got to say, Domino's always tries to portray itself as a tech stock.
Yep.
Comfort food, they're both in the same space. I'd probably go with Collins.
Right.
I don't think there's as many smoke and mirrors with Collins, whereas Domino's kind of tries to look over here, we're a tech stock, look over here, you can talk to your driver as he's coming up the road and see what music I don't care.
Right.
I want my $5 pizza.
That is hot and on time.
Exactly.
All right. Our final stock, Jock wants a view, Henry, on Templeton Global Growth Fund.
Well, it does what it says on the box, doesn't it?
Yep.
It looks at global growth stocks, invests in global growth stocks. You look at what they've got. They've got big positions in United Parcel, Samsung, Comcast, JP Morgan, Sumitomo. Its NTA is $1.38. It's trading at $1.30. So a very smallish discount to that NTA. And there's a lot of LICs out there that have a lot bigger discounts, and some even have premiums where you're buying $1 worth of assets for $1.20, and 20% of the assets are cash, and you're scratching your head and thinking, why are people buying this stuff? These guys trading a small discount, it does what it says on the box. It's a good quality fund manager investing in the sexy part of the world.
So a good manager though.
Good manager. Okay. They're relatively transparent as well, which is good. What you want with an LIC is one that you can see what they've got.
Yeah.
And they regularly report. You don't want one that says, oh yeah, this is the NTA, and then the next month it's gone up by 10 cents or 10% or down by 10%, and they don't really, it's like, when you're at school doing your maths problems, explain your workings, guys. You need to see your workings, because that's where the marks are. Yeah. So if these guys are transparent, and these guys are, then that discount is closed up to their NTA. But if you're not transparent, you say, oh, it's all a black box, we're not going to tell you how it works. Yep. Everyone just goes, oh, that's too hard. That's the ones with the bigger discounts. Okay. So it does what it says on the box. Quality management, good fund manager, invested in the right things. It's transparent. If the assets that it owns go well, it will go well. But there's not a huge discount. So it's good.
Tim?
I agree with that. I mean, the LIC story is basically the same across the board. Most of them have got a slight discount to NTA. For us, just looking at the performance, you've got a short period of recent outperformance and then a very long period of underperformance. And for that, they're charging a 1.2% fee. For us, given their performance, that's a bit pricey. We like that it's a growth-orientated fund. I mean, growth has outperformed value for a very long time now, and I don't see anything changing that yet. But and it's mostly exposed to the US and Japan, very heavy ratings there. But for us, it's just an almost generic LIC that hasn't performed amazingly well with a slight discount to NTA. I mean, all the index ETFs seem to be doing quite well. For us, it makes sense that you go to active at the moment, but then there's so much unpredictable stuff going on at the moment. Who would have predicted that JB Hi-Fi would go gangbusters in the middle of a recession? And a lot of these guys are underperforming due to the unpredictability of not seeing a pandemic for so long. So it's a hold. It's fine, and especially if you want growth, active management, then perfect. It ticks the boxes, so hold.
Okay. All right. Okay, let's just recap the final 5 stocks. Nufarm, a no from Henry, a cautious buy from Tim. REA, a yes from Henry, a hold from Tim. Viva Energy, a no and a hold. Collins Food, a yes from Henry, a hold from Tim, and the same with Templeton Global Growth. Tim from Catapult Wealth in Adelaide, great to have you aboard again. Good to see you.
Thanks very much for having me on, Koshy.
And Henry Jennings from Marcus Today. You can go and cash in your Biden bet now.
It wasn't big enough, but it was nice.
What did you get at?
$3.20.
Oh,
and the big Florida sell-off, and then
it was like a yo-yo yesterday, wasn't it?
It was fun to watch. To watch.
Exactly. All right, mate. Good to see you.
Good to see you.
All right, that's our show for today. If you'd like us to cover any stocks you're interested in, send an email to call@ausbiz.com.au or via Twitter using the @AusbizTV handle. Reminder, if you want to see all the stocks in the calls portfolio, go to ausbiz.co/portfolio. Catch up on everything that's happened in the day in business and finance with the COB, an email every afternoon from Nadine and Scuddy wrapping up the day and what's happened on the markets and in business. To subscribe, go to ausbiz.co/join. It'll be in your inbox 5:30 in the afternoon. And the Startup Daily Show between 2 and 3 today. They're joined by Michael Fredericks from Foo, which is a new buy now, pay later service to give Aussies quick access to cash. That's coming up on the Startup Daily Show. So a lot more happening on Ausbiz throughout the afternoon. A lot to look forward to. Stick around. In the meantime, we'll see you for the call at midday tomorrow.